March 20th today, Sunday, March the 20th. We have another week behind us and a Fed meeting behind us and some curious action in equity markets, in the U.S. equity markets to close out the week, which if you had asked me after the FOMC statement on Wednesday where I think we would finish Friday, I certainly would not have said in the range where we did finish. So we'll have a look at that coming up. Let's start with our yield curve, our par rates on the screen here from January to March. Here is the total change in rates. You can see they're all increased. Look at the 2-year, up 119 basis points since the beginning of the year, almost a 2% 2-year. The 3-year up 111 basis points. The 10-year over 2%, 2.14. And the 30-year at 2.42. These were higher on Wednesday after the Wednesday's close of the bond market. The yields were measured higher. And then yields got lower on Thursday and then lower on Friday. So what you're seeing here, this final row on the 18th, is actually yields that were higher than they were on Wednesday. So even though the market decided to move upwards, volatility in almost all equities have dropped. Volatility at the level of the index dropped significantly. There was still money flowing into bonds going into the weekend, which seems odd with everything else that was going on. The US dollar weakened after the Fed raised rates, which seemed odd. Oil elevated up above 100 and kept going while equity markets kept going up, which seemed odd. So I have more questions than answers in this video, but we'll look at a whole bunch of indicators, we'll look at a whole bunch of information, and then we'll just decide what's important, what do we want to look at for the week, what's going to give us some information. Look at the slope. This is a big one to pay attention to. The 5 to 10 segment is completely flat. The 5-year is yielding 2.14%. The 10-year is yielding 2.14%. The 7-year, you got a 217 in there, but that's just a few basis points difference. You got a flat segment of the curve. I believe at one point during the trading, it did turn negative, but finished the week flat versus 4 basis points the week before. All segments of the curve, whether you measure it from the 2 to the 10, the 2 to the 20, the 5 to the 10, or the 10 to the 30, all segments flattened altogether, and you have a completely flat segment at the 5 to 10. An inverted curve is sort of a signal to bond market participants that there is an impending recession or the potential for an impending recession. Otherwise, rates would be different. That you would have an upward sloping curve if you didn't expect that to happen. So that's going to be interesting to watch to see if it affects the psychology of market participants. And if it affects the psychology, it will affect their actions, which then may have some effect. I don't know. So we're going to have to look at that. Curvature hasn't changed. Negative 11 basis points. It was negative 11 basis points the week before as well. But rates, week on week, all rates week on week, all except for the 2-month, are higher. We'll be looking at some of the summary of economic projections from the FOMC, and we'll read the statement. We'll look at the statement from the FOMC as well, which was rather overall a lot more hawkish than the market had expected. Even though they only moved 25 basis points, some of the things they said were more hawkish than the market had expected. Yet equities felt the need to run almost 200 points. It ran 100 points into the meeting and then ran another 200 points after the meeting, which again is odd. Let's look at real yields and break-even rates. Given the stance that the Fed took on Wednesday and their more hawkish statement, I would have expected inflation expectations to moderate because it does look like they are going to act more aggressively than the market thought. And that is exactly what happened. If you look at the break-even rates for March 18th over March 11th, they're all lower. Not by much, but they are lower. They all gave away a little bit, 4 basis points here, 8 basis points here, another 8 here. We got 9 here and 7 here, lower on the break-even rates. And we can see our real yields are all higher. This used to be positive a few weeks ago, then it turned negative all the way to negative 22. Now it's climbing back into positive territory. And if real yields go positive, they'll go positive from the long end backwards, because as you go further out, inflation expectations drop. Nominal yields are increasing, which should increase the real yield. Here's the one we want to watch. Can we get a positive real yield on the 10-year? So let's look at the statement that we had. Actually, let me just say a little bit more about the break-even rates. They're all going in the right direction, based on what would affect the trader, in terms of expectations, because you can respond to data as it comes out and determine where the trend is, but until you see something, you have to work with expectations. These expectations are all suggesting moderating inflation, which is counter to 2 other reports that we saw this week. Well, it's counter to the summary of economic projections from the Fed, which we'll look at down here, and we'll read a little bit on the screen. And it's counter to a release put out by the OECD on March 17th. It lowered global economic growth and raised inflation forecasts. So for inflation expectations to be coming down, it's a little bit different than what some projections are from central banks and from the OECD. Last week, for those of you who had watched the weekly update last week, I had said on March 16th, this was on the Sunday before the Fed meeting, I said I expect, based on everything that had been going on, I'd been refining my probabilities week on week on week. And by the time we got to the Sunday before the March meeting, I put 100% probability on a 25 basis point move, 0 on a 0-point move, because, well, inflation actually was worse or trending the wrong way, but not 50 because, well, you have this issue in Eastern Europe going on that's, there's not much that interest rate hikes are going to do on that one, and that one's going to cause some global slowdown on its own. And we got 25 basis points. I'd also said to expect no balance sheet reduction, and there was no balance sheet reduction, although there was a statement saying that it is going to happen at an upcoming meeting, implying that look for 2022 for this to start happening. We're going to look at the statement, and we're going to look at the release, the other release, which was the summary of economic projections. All the links to everything in this video, any source, is in the description box below. But just some highlights from the summary of economic projections. Real GDP was 4% at the end of December. Going into 2022 has been lowered to 2.8% for the U.S. Core PCE was the forecast was 2.7 at the end of December, is now 4.1. So you have real GDP growth decreasing with inflation actually increasing. So to have this drop in inflation expectations, a little bit at odds with this, and we'll look at what OECD says or what they're sort of suggesting as well. This is a big one here. The federal funds rate at the beginning of the year. This is December 31st, 21. The forecast for what it will be December 31st, 22 was 0.9%. It is now 1.9%. We're at 0.5. So you're looking at 140 basis points higher, assuming that we go 25 basis points per meeting. That is 5 to 6 more rate increases for the course of the year. And going out to December 23, which is the end of the following year, this is for December 22, December 23, 2.8%. So looking at 4 25-point rate hikes through 2023, assuming that inflation follows what the Fed is expecting. So we'll look at what the Fed is expecting inflation to do. We're seeing here that they're thinking 4.1. Well, at another meeting, that may actually increase because we have Eastern Europe that is dragging on, and it is causing issues. We have, and I'll mention it on the screen when I talk about the U.S. Canadian currency, we have the largest railroad in Canada on strike, which is going to cause even more supply issues. Product that's not going to be able to get to the market that it wants to get to, so that's going to cause more grief because there's a lot of trade between Canada and the U.S. So it's if we see this creep higher, then you're going to see this creep higher, and you're going to see this creep higher as well. But this is where we are now, which is more than what was expected, more hawkish than the market had initially thought the week before the meeting. Yet the market felt the need to go higher, and inflation expectations came in lower, and nominal yields from the Wednesday close, the day of the meeting, the initial reaction was, whoa, this is really bad, and yields really increased. And then Thursday, yeah, maybe it's not so bad. Everything is still going on that was going on. In fact, it's getting a little bit worse, but so what? And then Friday, I thought, well, maybe we'll get a reversal Friday into the weekend. No. In fact, the market was hitting the highs into the close. Money couldn't get into the market fast enough at 359. And I'm looking at this and I'm thinking, this doesn't make any sense. But then again, we have to take it with a grain of salt because Friday was options expiration. Not only just options expiration, it was what's called quadruple witching. And then after, I think, 1:30, one of the markets close. I think it's either 11 or 1:30 where one of the witchings drop off, and then it's triple witching into the close where, depending on how dealers' books are stacked in terms of what side of the options they're on, gamma risk is really high. You have to buy and sell to hedge out right into the end of the day. So all sorts of weird things can happen. And the SPY volume on Friday was 66% of its 30-day average volume. So it was lower than expected, which whenever I see big moves on low volume, I'm kind of suspicious. Anyways, let's read the Fed release so that we know what that says, and then let's look at the summary of economic projections. Okay, this is the release at 2 p.m. on March 16th. Indicators of economic activity and employment have continued to strengthen. Job gains have been strong in recent months, and the unemployment rate has declined substantially. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures. The invasion of Ukraine by Russia is causing tremendous human and economic hardship. The implications for the U.S. economy are highly uncertain, but in the near term, the invasion and related events are likely to create additional upward pressure on inflation and weigh on economic activity. So we have, let me just stop right there. We have, as you'll see, a statement, and when we look at the summary of economic projections, a position from the Federal Reserve that is more hawkish than what people anticipated. And paragraph 2 is saying, on top of all that, you can add more inflationary pressure from this event and less economic activity from this event as well. So we'll compare that with what actually happened. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long term, with appropriate firming in the stance of monetary policy. The committee expects inflation to return to its 2% objective and the labor market to remain strong. In support of these goals, the committee decided to raise the federal target range for the federal funds rate. This should say by a quarter to 0.5%, and anticipates that ongoing increases in the target rate will be appropriate. Not just another, but ongoing increases. So that sort of signals that every meeting is probably a live meeting, and we can expect that the next meeting we're going to see another 25 basis point increase. I don't think they're going to skip a meeting. I think if they have it in their head that there's going to be 5 rate increases, it'll be 5 in a row or 6 in a row, and then they may sit out the last 2 months, but I think that all the rate increases will be front-end loaded. So each meeting will be a quarter point. So I expect that to happen at the next meeting as well. In addition, the committee expects to begin reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities at a coming meeting. Now, they're not being very clear on what meeting it's going to happen, but at a coming meeting, that is not telling me next year. That's telling me, sometime in the next 2 or 3 meetings, this is going to start. Maybe not the next one. I don't know. But certainly, if we're going out 3 meetings, I would expect that within those 3 meetings, it would be announced within those 3 meetings that that's going to happen. So there's a little more to it that you can read as well. The last one, James Bullard dissented and said, no, I don't vote for 25. He wanted 50, a lot more hawkish than the rest of the committee. Let's look at the summary of economic projections. This is the opening page of it. This is the table. Here's 2022, 2023, 2024. And here is the variable change in real GDP, and then the number below it is the December projection. So December was 4%. Change in GDP is now 2.8%, 1.2 percentage points lower than it was in December. 2023, no change. In 2024, no change, and nothing in the longer term. Doesn't make sense to start projecting out 2, 3, 4 years, much of a difference in that unless something significant is going on these days, because the further out you predict, the wider the variation becomes. I think this is more important here, 2022. Unemployment rate, no change here, meant to stay strong, and note, they expect it to stay at that rate for quite some time. Inflation was the December projection 2.6, now 4.3. And the core, which is the bigger number here, or the number they pay attention to, 2.7 to 4.1 on the on inflation. And if you want to scroll through this, they've got some really interesting charts that you can look at here. This is change in real GDP. Here's actual real GDP, and then they give you box plots, box and whisker plots for the trend in real GDP. So if you take out this pandemic period where you had a big drop and a big bounce up, and you just extend it across, you can see that there's really not much change in GDP. Back from 2017, 2018, kind of looks like it's going to be flat over that period of time. Unemployment rate, inflation, we see here, they can see it really moderating for 2022 down into 2023 and 2024. There's your longer run rate of 2%. There's your core as well. Here is the assessment of appropriate monetary policy. Each dot is one voting member of where they think in the end of 2022 rates will be. You've got somebody saying, well, a little bit under 1.5, looks like about 1.3. The majority are here just below 2%. There's your 1.9. You got somebody way up here at just a little over 3%. This is 2023. Here's the range of where they think, each member thinks that the terminal rate will be at the end of the year, 2023, 2024, and then lowering in 2025. And again, if you keep going, this is distribution of participants' projections for the change in real GDP. This little dotted line over here is the range of where the participants thought real GDP would be. Now it's over here. So you can see that the whole range has shifted downwards. It's not just 1 or 2 that got really bearish. The whole range has shifted downwards. 2023, not much change there. Same with 2024, and the longer run, exactly the same. This is the unemployment rate. Nothing really exciting to see here. Here is the distribution for inflation. Earlier, we just looked at a point estimate. This is the distribution. This is where members thought it was, and there's always a distribution. One person thinks it's going to be here, one person thinks it'll be up here. the whole thing has shifted. In fact, you have one person on an outlier. That's probably Bullard, and that's probably why he wanted the 50 basis points, because he probably sees it as being much more significant than it is. And then moderating, that's probably Bullard over here saying, well, sure, it'll moderate, but not enough. We need to be a bit more aggressive. In the longer term, everybody is saying, yeah, if we do our job, we should get to the longer term rate of 2%, which is what we're all doing here. So in the longer term, you're going to get there. Of course, everyone's going to say yes. But when's the longer term, right? Yeah. Distribution of participants' projections for core PCE, and you can see the whole range has shifted upwards as well. This is 17 pages long. I do recommend that you click on the link and have a look at it. But we've seen what we've wanted to see on this one. On Thursday, on March 17th, the OECD put out an update to its economic forecast for 2022. Last week, when I did my weekly update, I listed a number of issues that were of concern. This was before the Fed's meeting. This was before they released their summary of economic projections, and this was before the OECD put out their update. I had said that inflation is a headwind, and especially with what's going on in Russia-Ukraine, that's not going to make it any better. Maybe it's not going to get a lot worse, but it certainly isn't a net positive. Overall, it's a net negative, and same for global growth. I said that had to be a net negative. So I think that you're going to see some projections come down. And we are seeing projections come down, but we are not seeing earnings projections come down. The consensus estimate on the S&P, even though we're seeing companies that are guiding downwards for Q1. And we'll look at that down here. This is from FactSet. Again, everything that you see on the screen has got a link in the description box. You can go read it yourself in case you feel that, I might be cherry picking or interpreting something the wrong way. I have all the links there. This is from the report from the OECD, the figure 5. And we'll go to that report in a few minutes, and we'll look at it a little bit more detail, but this is a kind of a nice one to start with. The conflict implies a substantial hit to global growth. When you see that word, not a hit and not a downward, a substantial hit to global growth and stronger inflation. And this is the difference from their baseline that they originally had. And this is just the incremental difference just because this thing is going on. And they break it down into the impact that higher commodity prices will have, and the impact that Russian domestic demand and financial shocks to the Russian economy will have as well. Euro area, a hit to real GDP of 1.4%. The U.S. is over here. This is 0.88%. They lowered that for the U.S. based on what they originally had, and we saw with the summary of economic projections from the Fed, they went from 4% down to 1.2%, down to 2.8, which is a 1.2% drop, not 0.88, but they were 1.2%, and that drop has to include everything, including Ukraine. So they went a little bit more than the 0.88. We can see this for the world. It's a little over 1%. I think this came in at 1.08%. And then you have the world excluding Russia, which is just a little under 0.8%. That is the impact on GDP. Here is the impact, the incremental impact on inflation. So they said, you thought inflation was bad before this happened, add this much onto it. And of course, they break it down for what's going on. Because Russia is not going to be in the market anymore, they're not going to be demanding things. Some of the stuff that was imported into Russia will now be available to other places, so you notice that it actually has an offsetting effect in some places, and it has an incremental effect in other places. So it's all higher. If you look at the U.S., it's almost 1.5% higher in inflation than it otherwise would be. For the euro area, you're about 2.3% higher. So you got a 1.4% drop in real GDP combined with a 2.3% increase above in inflation. It is getting to be, I think, more than even odds that the Eurozone may see a recession later in this year. When I say more than even odds, that means the probability is not just even, like, it could be, it couldn't be, but, more likely than not, 55, 60%. Now, all of this, curiously, is not reflected in the consensus earnings, because when I searched for the latest agreement on consensus earnings, it was a little bit higher, came in at 226.38 versus 225 and change, mostly because energy earnings had been updated, but none of the other earnings had been changed as of yet. However, this is from FactSet, earnings guidance for Q1 2022. 95 companies have issued guidance for Q1. Q1 is April. We're going to get these results April, May. The majority of companies will report in April and May, and so we're a good 3 weeks out from the start of earnings season. And I think that's going to be the big focus. There'll be some economic data points along the way. Russia, Ukraine is unfortunately drifting into the background. As I said last week, the longer this thing goes on, the longer it will become normalized, or not the longer, the more it will become normalized, and it will just become background noise. So I don't know that that's going to dominate the headlines. I don't know that we're going to move from headline to headline. Russia bombed this city. It'd be, they bombed another city the other day. They'll bomb another city tomorrow. Unfortunate, but that's just the cold reality of the markets, is that once it's priced in, it just fades into the background, and there it is. It would have to get significantly worse or significantly better. However, while I'm on that topic, even if it ended today, these sanctions on Russia are not going away. That's damage that's done, and it's going to stay for a while, and I don't see them going away unless there's a regime change. So as long as Putin is going to stay in power in Russia, I think those sanctions are just going to be part of the zeitgeist. They are simply going to become normalized, and that's the way it's going to be. So as I said last week, there is no upside to good behavior on Vladimir Putin's part at this point. There is no upside to good behavior. Even if he said, I'm sorry, I'm pulling out, everything is gone, nothing's going to change for him. Nothing's going to change for his fortunes. So in his mind, it's, if there's no upside to good behavior, I may as well push forward, right? Let's just read this. For Q1 2022, 66 companies have issued negative EPS guidance, and 29 have issued positive EPS guidance. That is 69% of the companies that have issued guidance. 69% have issued negative guidance. It's not uncommon for companies to issue negative guidance, and usually it is in their best interest to do so. If they know that they're not going to make it, usually a month ahead or a few weeks ahead, they will update their guidance, and they will guide to the lower end of the range, or they will guide to a new point. It's quite common to do that. Usually it's around 60%. So when we think 60% of companies that issuing guidance are negative, is because there is a reason to do it. There is a motivation to do it. You don't make a lot of friends in the investment community by surprising them on earnings date. You want to give them some runway to make some changes, and you get friendlier investors that way. So the long-term average is about 60%. We're at 69%. I don't know that we can read too much into that, but there it is. I think what is different this time is the number of companies issuing guidance. I think it's usually around 40, and this is 66 now. So it's significantly more companies. So as a percentage, the percentage is elevated, 69 over 60, but the pure number itself is higher. Let's have a look at this report in a little bit more detail. All right, this link is in the description box as well. You have your summary of all the main points if you want to read those first. the exhibits, I think, are really well presented. You can get a lot of information out of the exhibits. Prior to the war, a global recovery was underway. It's a starting point. But then, guess what happened? This is a kind of a neat little thing. If you want to break down to see which country has the most exposure to this, this is domestic value added exported to Russia. 2018, this is the percentage of countries' total value added. It gives you the countries down here of which ones would be most affected. To serve Russia, final demand in blue, and as inputs embodied in Russian exports, these are the green ones. So the blue means it's imported into Russia and there's where it stays. The green means it's imported into Russia, it's part of another assembly of something else, and that then gets exported out. The prices of principal export commodities of Russia and Ukraine have risen sharply, and it tells you which commodities and the price increases. So this is as of March 15th, 2022, and this is the average from February 24th. Look at the price difference here. Nickel. This is big in batteries. So it was curious. Not curious, I think it was in line to see most of the EV manufacturers raise their prices. Tesla raised its price. I think there was another company that raised its price as well. I forget the name of it. I think it was the Chinese EV manufacturer raised its price. The question of supply has to be raised as well. Is there going to be enough supply to meet the demand for batteries, to meet the demand for the amount of EVs? I don't know. But Tesla's price in the last couple of weeks have gone from low 800s to just a little under 900. So they don't seem too concerned with the price of nickel. Coal, wheat, that's a big one here. And we'll see a little bit later where most of this wheat goes. And it goes to countries that can least afford to see their food prices increase. In developed countries, the amount that we spend on food as a percentage of our income is fairly low, but in developing countries, it's very high, which means that you crowd out a whole bunch of stuff by raising the price of something as basic an input as wheat. There's corn, platinum, you see gas to Europe, oil, and it just gives you an indication of the price changes here. Figure 4, wheat imports from Russia and Ukraine are very important in some countries. It tells you where they go. Look down here. From Russia and Ukraine, from Russia especially to Turkey, 65%. Egypt getting close to 50%. So, if we're going to look for countries that are less willing to sanction Russia on certain things, these are the countries you would look at from the bottom upwards. This is the one I showed you already. There's another one down here that gets rather interesting. Not this one here. This is a suggestion saying, listen, if countries use fiscal policy, that means more government spending, they could minimize the impact of all this. So this is the full shock down here. This would be the fiscal response in gray, which means that instead of being down, the euro area's real GDP, instead of being down 1.4%, it would only be down 0.9%. So even with government stimulus, you're still going to have a drag on real GDP. The problem comes over here, is it adds to inflation. So the orange bar is a full shock, and then if you have a fiscal response, it actually pushes inflation higher. Which would then force the central banks around the world to increase interest rates at a faster rate. And those consumers that carry debt, and let's face it, a lot of consumers carry debt, whether on credit card debt or mortgages, would be squeezed there as well. There's no guarantee that any fiscal stimulus will actually have the multiplier that that I think economists like to believe it will. So it's sort of suggesting that, yeah, you can minimize the hit, but you're still looking at a hit. anyways, it's interesting to keep going on. There's a whole bunch of interesting stuff here. I do encourage you to read that. So let's think about valuations here. We sort of have an idea of what interest rates are going to do over the course of the year, what inflation is forecast to be, what economic growth is forecast to be. I think there's a general consensus that from here to the end of the year, interest rates will be higher. From here going forward, inflation is probably going to increase or at the best not improve for a little while. That maybe by the end of the year inflation may moderate, but it's certainly not going to happen in the next month or two. And that GDP, I think there's a general consensus, real GDP is going to be lower because of what has happened in Eastern Europe than it otherwise would have been. So we are facing that. But we've had a pullback in the market, even though we've had a rally. We're still below the high. So where are we on valuations? And we'll look at a couple of different valuation metrics. I've done this over the last couple of weeks as well. We've looked at forward PEs, trailing PEs. We've looked at the CAPE ratio. We've looked at valuing the market in a number of different ways. Looking at it in time based on the type of regime or the central bank regime that we happen to be in, and trying to see if we can't pull that apart. We'll introduce another one, the Buffett indicator, or at least it's being called that for quite some time now. This is market cap to GDP. We'll look at that. Forward PE, where do we stand now? There's the closing on the index. Here's the new EPS, which reflects higher energy earnings. I just don't know that it's reflecting all of the changes in EPS that were expected or that are going to be forecast. I don't know if there's been any downward revisions. Companies have come out and guided lower. 66 of them have come out and guided lower. I don't know if it's in that number. I have a feeling that it's not. Anyways, if we just accept this number, we get to 19.71 times forward PE. 5-year average is 18.6. The 10-year average is 16.8. So over the 10-year average, we are overvalued. Versus the 5-year average, we are slightly overvalued. Except now we have, and I'm just going to use the word myself, Putin can sanction me all he wants. We have the war in Ukraine. We have inflation at a level that we didn't have over these last 5 years. We have interest rates going up, which we did over this 5-year period. There was a period of time where it did go up and then came right back down, but we have interest rates. We still have supply channel disruptions going on as well. That, with all of the uncertainty, are we comfortable being slightly overvalued basis the 5-year average? If we look at it in terms of a trailing PE, this is last year's earnings. Here's where we are. We're 21.3. The 5-year average is 23.9. The 10-year average is 21.8. That would suggest, well, on a trailing basis, you're fairly valued. So why the big difference between trailing and forward? It's because growth is anemic here. The projected growth for this year is going to come in lower than last year. So the trailing will look better because it had great earnings over the previous year. But on a trailing basis, that's fine. However, valuation is forward-looking, so we want to try to find some better indicators. Using the Shiller PE, the CAPE ratio, we've already seen that a few weeks ago. It is suggesting that the market is extremely overvalued. This is the market cap to GDP, and here we're going to use the Wilshire 5000 because it is the most representative of the total market cap in the U.S. to U.S. GDP. The long, this over here is the median, or the mean is 90%. And different ranges mean different things. 50 to 75%, you are moderately undervalued. 75 to 90%, you're fairly valued. The 90 to 115%, you are modestly overvalued. We are at 184.79% or 185%. Even at the height of the dot-com craze, way over here, you were sitting just below 150%. Even 2007, that hot housing market. If imagine, at that time we thought, man, property prices are ridiculous. Wouldn't you just love to go back to those property prices now? I mean, I look at what prices are now for just in my neighborhood. It's ridiculous. It's absolute. Thank God I own a house, but it's ridiculous for anyone trying to get in. And we thought that 2007, 2008 was ridiculous. Wouldn't you love to go back to those prices? I'll take 3, thank you. And that sort of didn't end well. And that was just that. Here we are here, 185%, with housing that has been absolutely ridiculous. On the next screen, I'm going to compare changes in the interest rate regime with changes in this ratio. But we're going to go a little bit further on the next ratio. This is just public. This is Wilshire 5000. These are just public equities. Next screen, we're going to look at public and private, and we're going to see where we are on public and private. But using this indicator, would say that we are massively overvalued. This is suggesting, being above the 5-year average and being well above the 10-year average is suggesting that we are somewhat overvalued. The CAPE ratio is along these lines as well. Once you adjust for inflation, it is saying, look, you're significantly overvalued as well. Let's have a look at the next one, and then we'll look at the site that I got this from. Super interesting site with a whole bunch of really great stuff. If you want to lose a whole weekend just looking at stuff, this is a great site for it. Okay, our top chart is the value of public and private equities to GDP ratio, and the bottom chart is the federal funds effective rate from the St. Louis Fed. You always want to make sure that you have good data sources. By the way, the site that we're going to visit here in a second that generates this chart gets its data from the same source. So when I saw these charts, the first thing I did was I look at, well, where are you getting your data from, number one? Because if I don't like where you're getting your data from, I don't care about your chart. And I saw the source, like, oh, okay, good enough. It saves me the trouble of having to get two different series and doing the math myself. So this is public and private corporate equities to GDP ratio. And I've broken it up into the interest rate regimes we have down here, because this is 1950 over here. This is 1985 on this one. It doesn't line up. But I've put them in terms of regime 1, regime 2, 3, and 4. Notice that each regime we had lower and lower rates until you get to this thing that we've never had before, which is basically sitting on the zero line for a whole bunch of years. And here we are sitting on the zero line again. What can we make of this? Well, if we go back to the period before 1990, here's where we were. Fairly constant on this ratio to GDP. Then you had a drop in rates. You could see that all these rates are lower than the previous term, and you had a move up. Then you had another drop in rates, and if you look at this move and you find the average, it's somewhere in here, and then you pretty much went sideways. But if you look at the average in here, you're somewhere in here. So you went from one average to here to here, and then again we dropped down right to the zero line, and this is what happened. Look at this ratio, 334%. 334% on the previous screen. We saw 185% just for public equities, and when you get into private corporate equities, it's even higher. Valuations there went even higher. And I think, it's the same with housing. If we look at a housing index and housing prices with each new interest rate regime, you would see housing prices doing this kind of thing. Because it is a discount rate. If you lower the discount rate on all future income streams from anything, you're going to get a higher present value. So if inflation and your discount rate is going to be your risk-free rate plus some inflation expectations, well, we already know that rates are going up, inflation expectations are going up, your discount rates are going up. This ratio can't really hold. Now, if we think that, well, no, equity prices can stay where they are or equity prices can push higher, but GDP growth is going to slow down, if you're going to get equity prices increasing, let's say we think they're going to increase 10% over the year, but GDP along with, well, these are nominal prices, so you have to have nominal. We had 2.8%, and I think we had what was the core? 4.9%. Let's go to 4.9. I think it was 4.1, but 4.9. This is less than 10%, which means this ratio can only go higher because you have a numerator that's going to increase faster than a denominator will increase. So what we're saying is that an indicator that suggests something that's overvalued is going to go into an area where it suggests it's even more overvalued. So one of those things are wrong. Either all of this is wrong and you're going to have far greater growth, and that's what the market is pricing in, that growth is going to catch up to this, or that you're going to have far less inflation than what we really think, or this is in question. The continued upward movement in asset prices. And, it depends on where you're standing. You can look at a whole bunch of data, but I just cannot see where you can take everything that we have and suggest that, no, this implies higher economic growth than before and lower inflation. Maybe you think that well, it's not going to have any effect on economic growth. Maybe you think that. I don't know. But that's what makes a market, right? You have people who have all sorts of different interpretations of the data. I myself think that global events right now, especially with inflation and with geopolitics, is net negative. And even if geopolitics is solved, the commodity price issue is not going to be solved because the sanctions are not going to go away. It's net negative. And I think that inflation is slowly becoming entrenched. And listen, you only need one more negative event on top of all this to put that extra pressure on. What can't happen right now is another bad data point. So if China sides with Russia and buys Russian oil and says, listen, we'll help you around the sanctions, and if the White House says, oh, well, we told you what would happen, we need to start sanctioning China, that can't be positive. That can only be a net negative. One analyst was saying, just to add one more thing to this, was saying, what the pandemic has shown companies and what the geopolitical events in Eastern Europe have shown companies is that supply channels can be disruptive to business with too much globalization. So there is a move to what he refers to as resilience. Resilience is to making the supply channel resilient. And that means there's going to be a certain amount of localization that has to happen so that you always have some source of supply, that you can't have these supply channels that span 15 different countries because that supply channel is only as strong as the weakest link. Well, if you go from resilience to localization, he says you go from globalization to slowbalization. I thought that was a neat little word, slowbalization. In other words, if the move from localization to globalization was positive for GDP growth, for world GDP, the reverse has to be true as well. It has to be negative for GDP. So resilience sounds like a good idea, but resilience does have a cost, in that things will cost more to have that redundancy in place and to localize. If it was cheaper to make it in this country, it's got to be more expensive to make it in another country. That's why you were in that country to begin with. So if that trend continues on, which I don't see why it wouldn't, right? Then you can expect that that's going to be a headwind to growth as well. Okay, here's the site Long-Term Trends. If you haven't been to that one, it's got a whole bunch of great charts and indicators from not just economics and finance, but from a whole bunch of different disciplines. You can get lost in this thing. This is the Wilshire 5000 to GDP ratio, the one that I saw, and it gives you the data sources from where it got it from. It's the Federal Reserve Bank of St. Louis. Good, because that's what I would have used as well. And then you have further information here. If you want to dive a little bit deeper into other things, you have more information here. Value of public and private equities, I showed you this one. We can scroll down to, here's the S&P 500 to GDP. In other words, what's the value of the S&P 500 divided by GDP? It's going to be very, very low. And where are we here? 0.179, but it's still elevated over the long-term average, 0.1. If we draw a line around 0.1, it looks like maybe that's a more attractor point. There is the dot-com bubble, the bubble. 0.144. This was 2007. Again, when we thought that, wow, things are going crazy in the property market. This is inflation was creeping up at the time. Oil was $120, $130 a barrel. Copper was elevated. Everything was. We were only at 0.105. You're sitting at 0.179. This is S&P 500 to GDP, and the S&P 500 tracked very close to GDP. A little bit higher here, but then it pulled back, a little bit higher here, a little bit lower there, it pulled back, but then it just took off altogether. And that's it. It gives you, for further information, if these are kind of neat little links that you can click on. This tells you what data sources it was as well. So if you're interested in poking around a whole bunch of interesting things, long-term trends, really cool. Okay, let's try to make sense of where we are and what we think we can set up for the week. What are we looking for? What is going to support us? What is going to hurt us? Depending on whether we think we're going higher or lower. For those of you who know me, I don't like technical levels. I prefer fundamental levels. So here are 4 fundamental levels on the market. Actually 5. This is where we are right now. Forward PE of 19.71 based on the closing of Friday. So the market is valued at 19.71 times forward earnings. We know the last 5-year average was 18.6 and the last 10-year average was 16.8. I also make a note here, West Texas Intermediate futures ticker is CL, closed at 105.10, elevated price. So it fell down to the low 90s and then just came right back. So oil is saying, this thing over there in Eastern Europe, that's not really done. Although that may not be a fair assessment, only because oil prices were rising before that happened anyways. That the miles driven, I was watching a presentation given by somebody to the Princeton community, and miles driven has recovered to pre-pandemic levels, but the amount of gasoline supplied has not, so that there is a greater demand than there is supply at this point in time. Well, here's where we are. Here's 20 times. That would get us to 452 on SPY. 21 times would get us to 475, almost to the highs of the year. So that's, saying, well, let's get a multiple expansion going on. Do we see higher multiples given everything that we have? You may have a different interpretation of it, but I'm having a hard time with it. One other thing that I didn't mention, I have mentioned in previous updates, is corporate profits as a percentage of GDP. The mean reverting level for that is about 6%. It is sitting at 12% right now, which is the highest it's been, 12%. So to think that we have a multiple expansion, we would have to think that, well, this will be maintained or maybe even go higher in the face of everything, that we're not really going to get any GDP contraction. We'll actually get stronger global GDP from this. I just can't see that. I haven't seen that for a while now, although this last week over here, up 300 points, 4 days, up 300 points. Up about 100 points before the FOMC meeting, and then another 200 points after it was over, given everything that we have. 19 times is 430, and if we go to 18 times, which is still above the 10-year average, but slightly below the 5-year average, that gets us down to 407. Implied volatility, the percentile. I don't like IV rank. I like IV percentile. 13-week, 41%. So a lot of the premium has come out of the options. So at this point, selling options doesn't have that rich premium in there that I like, because we're down to, here we are, under 20% on implied volatility. At the beginning of the week, we were close to 28% implied volatility. We're down to 19%. So I had sold calls during the week that even as the market was increasing, my call prices were not increasing in price, because the implied volatility was coming out just as fast as the delta was moving. So by the end of the week, I was pretty much even on the calls that I sold, even though they're in the money calls at this point in time, only because the implied volatility took away the premium faster than the delta could add the premium. So that's kind of nice that I got to sell it before the premiums disappeared, but the premiums are lower, and if implied volatility falls even more, I don't think I'm going to be that excited about selling options, because there's just not a lot of premium. I'm certainly not going to sell puts, not at low premiums like that. I like selling puts when there's super high premium. So when we get to implied volatility that's up around these levels, that's a great place to, wherever the market is, to go down below it and sell puts down there. That's just wonderful, because even if it's put to you, it's put to you at a nice enough level, at a low enough valuation that you can live with that. So, I look at the closing last week, and the last 10 minutes, 15 minutes, I thought, this is, it's going to reverse. There's going to be some selling into the close, right? No. 358, 359, 359 in 30 seconds, and it just kept going. And you're scratching your head going, okay, I'm going to chalk it up to options expiration day, because it is options expiration. And I did have a closing trade on an option, because I had a caller, and I thought, well, it's not so much of a caller, it was more of a strangle, where I had sold a call and sold a put. At one price I sold a call, and I sold a put at one price, and it was a $5 spread, but the premium was $6.43. So I had a bid out to close at 145. 141, 145. It was a 2-cent difference. 141 to give the other side some premium. No, hang on, I got it right. 145. Yeah, 145 to give the other side something. I know I went 2 cents more than the spread. And it got hit, I think, with 10 seconds left. So even going into those last few seconds, there were still rebalancing of books so that you wouldn't go into Saturday with any assignments. Had I just waited, this would have been assigned. It would have been put to me at this price. It would have been called away from me, and I would have made the full spread without having to give up 2 cents. But I thought, for 2 cents, why bother? Let's close it now. But even into those final few seconds, there was still that flurry going on. So I'm sort of thinking, I'm not going to read too much into this. I'm going to say, okay, well, we have options expiration going on here. We have a 25 basis point increase, which is, okay, it's behind us now. It's happened. We can live with it. Yields did decrease from Wednesday into Friday. There was hope that, I think, the tensions in Ukraine would subside on the weekend. Maybe the two leaders would have a face-to-face and agree to some sort of result on this. There's always hope, right? As the German saying goes, I can't say it in German, hope always dies last. Okay, so this is the economic calendar for the week coming up. We always want to be aware of what the next big event is. There's nothing really, I think, bigger than what's already happened. I think the news flow will still be dominated by any big event from Ukraine. The day-to-day bombing, the day-to-day this, I think, is going to drift into the background. It will just become normalized. But there has to be some big event. And the two big events, you can bookend Ukraine with two big events. Number one is Zelensky and Putin are going to meet, and it looks like they're going to settle some things and get it done. Even the announcement of the two leaders meeting will be a support for the market. On the other side is the battlefield nukes. I think he's got some missiles with nukes that are not those big megaton bombs, but they're like 2 or 3 megatons. and that compares with Oklahoma that was equivalent to 5 megatons but wasn't nuclear. But it's like 2 to 3, but is radioactive, right? So those are the two bookends. Anything short of those two will just be background noise, I think. And I think that everyone's going to be talking about earnings from here. The focus is going to turn to earnings and what we can expect from earnings. But it's always nice to just look at the calendar and see if there's, depending on what side of the market you're on, you don't want something to disrupt you. And if something is going to be an event where there's event risk on something, you want to make sure you don't trade in front of it, right? I'm going to go down it quickly because I want to point something out. You got the Fed Bostic speech. You got Fed Chair Powell's speech. Next day you have Williams, you have Daly, and you have Mester. Let's just keep going. There's Chair Powell again. We'll keep going. There is Daly again. And we'll keep going. There is Waller. There is Evans. And there is Bostic. Keep going. There is Williams again. There's Barkin and Waller. I don't think I've seen a busier Fed speaking week than this. It is full of Fed speak. So I would look for a lot of more detail. Now that the decision has been made, I would look for a lot more interesting details that might fill in a few things about what's going on. And if they reiterate the 5 to 6 rate hikes, if they reiterate the slowing down of U.S. real GDP, the increase that they expect for the year in the core inflation, and reiterate that 1.9 at the end of the year, or if any of them say we're willing to go 50 basis points at the next meeting, we're willing to accelerate the balance sheet runoff, then yeah, I think that could weigh on markets. But I've never seen more Fed speak ever. This will be a big one on Friday, Michigan consumer sentiment. You've got these things here, durable goods and market manufacturing. I don't expect these to move the market, even though they're high priority. They're big reports. I don't expect them to move the market, being what we have behind us and what we have coming in front of us with the with earnings. I think that'll be the big focus. And I think this week the Fed speakings, all the talks from the different Fed participants here, I think that's going to dominate the conversation. That and earnings. And, of course, Russia-Ukraine. But again, I'll reiterate, anything short of those two bookends, I don't see Ukraine moving the market anymore at this point in time. The longer it goes on, the higher the pressure on commodity prices, but I don't know that it would be a net negative for asset prices unless you hit one of those two bookends. Okay, so let's look at a number of different things. We'll look at the SPY, we'll look at the USCAD, and on the next screen, we'll look at GM. I've had some questions about GM because I am a big holder of GM. Bigger position than I would like to have, but I'm comfortable with it. And listen, you give me anything that has options, I'm good with it. It wouldn't matter if you gave me a loser. As long as there are options to trade, I can work my way out of it. I'm not concerned. Give me something without options, give me something without options and a dividend, well, all I can do is buy and hope, right? So anyways, during the week, I sold April calls and May calls. I sold April 430s and 440s, and I sold May 440s and 450s. And by the end of the week, I was not negative on these because of the significant drop in implied volatility over the week. I am on hold for now. I did not expect the run-up on Thursday. On Wednesday, after the announcement came out, the market did sell off and then rebounded. And I thought, yeah, but this is normal for Fed release days, that you'll always get some movement that you don't expect, but then it just corrects the next day. But it didn't. It continued on. Then I thought, well, okay, that's Thursday. Sometime mid-Friday, when all the dealers have closed their options books, things I'll probably see something that is more correct. And it just kept going, and volatility just kept dropping. So being that I am at the point of maximum uncertainty, I do nothing. I sit on my hands. This is 2 weeks ago. This is a volatility skew on the SPY. This is 2 weeks ago. You can see where it is today. Look how it's really come down across all prices. It's come down. Lower IV equals lower premium. So selling puts at this point, if you think the market is going to support its levels or go higher, you think now's a good time to sell puts. You're getting a little bit of premium, or you're getting less premium than you would normally get. I shouldn't say normally. Less premium than you would have gotten 2 weeks ago. How does that sound? Less premium than you get 2 weeks ago, which means you get less downside risk. My total SPY delta is slightly negative because I have sold puts. At the beginning of the year, I sold some 5-10 puts, which I still have. And on the way down, I sold puts, which I haven't closed. So my total delta is slightly negative. So any move up on the S&P is a loss for me at this point. And because of convexity, as the S&P moves higher, my losses get bigger and bigger as they move higher. So, I don't know how much upside there is, but listen, I'm going to say this right now. Don't copy me unless you know how to trade like me. Don't copy me. I'm telling you what I'm doing. I'm putting it out there ahead of time, so I'm not one of those people that come out after the fact and say, oh, I did this and I did that. Look how much money I made. I'm telling you before the fact what I do. In fact, you can go back through all my update videos, and I do that. I tell you exactly what I think and how I'm going to play this. So if the market does fall, well, I'll do very good on the calls. If it doesn't, there's enough premium in there that my break even is higher than this, and I don't mind if they get put to me and I have a short position. Why? Because they have options. Even if I have a short position, I can then use the option. If I say, oh, I'm totally wrong on this, I can still use the options to work my way out of that situation. Give me anything with options. And if they're liquid options, I can always work my way out of a bad situation. So I'm not concerned. USCAD. Last week, I put this up and I said, this is a puzzle. What is going on with the Canadian? Why is it so weak? We have a central bank that's raising rates sooner than the U.S. Central Bank. We have a central banker who is more hawkish, who's saying, listen, I'll go 50 points. Don't push me. I'll go 50 points. We have a Fed with a much lower balance sheet. Our jobs numbers are off the chart. We're a net exporter. We have a positive, we have a trade surplus, and we sell all the stuff that's gone up in price. Wheat, corn, oil, potash, gold, nickel. We have all that stuff and we export that stuff. Why is the Canadian so weak? And this was odd. When I said it last Friday, the Canadian US CAD closed at 127.49. This Friday's close was 126.04. So the Canadian did strengthen by 145 pips. This is a market quote, not a CFAI quote, by the way. This is a market quote. So you read this as $1 US buys this much Canadian, 1.2749 Canadian. Now it only buys 1.26, so it's down 145 pips. So the U.S. weakened against the CAD, or the CAD strengthened against the U.S. You could say it whichever way you like. I think it should be significantly stronger, but at least it went in the right direction. Here is this big thing of volatility there. There's the interest rate decision by the Fed. Fed raises rates, and the Canadian dollar then says, oh, okay then, now let's get stronger. Why? I expected it to weaken at that point, and it got stronger, which is, again, to me, another big question mark. As I'm doing this video a couple hours ago, it hit the news wire. CP rail strike in Canada, Canada's largest railway, which ships a lot of things. Just one more issue to add to the supply constraints. I put a question mark here, because I don't know what effect it's going to have on the currency, and I don't know what effect it's going to have overall. I know it's a net negative for economic activity in Canada. I know it's a net negative. I just don't know whether or not the market will look at this and reflect it into the currency price. I'm still short, though. I'm still short the U.S. versus the CAD. However, on Friday, I did lighten up a bit because I had a big short position on the U.S. versus the CAD. I did lighten up a bit going into the weekend, which is always a safe thing to do. I thought that run up in the market was a little too much, and I thought, well, let's just take some risk off the table. I did okay on some part of my trade. I still think it continues on, so I'm still going to keep it open. But this, I don't know what effect that's going to have. It would not surprise me if it weakened the Canadian dollar. It would not surprise me at all because it is net negative. And it would also not surprise me at all if the US dollar got some strength going into the beginning of the week as we digest the actual hawkishness of the Fed, and especially if the Fed speak next week. All of those speeches, especially if you keep hearing the same headline again and again and again, it makes you feel like it's more and more and more real, even though it's the same thing you're hearing again and again. So U.S. strength into the week would not surprise me. So lightening up maybe was a good thing. Here's the thing, we don't get to play this side of the chart. I have to play this side of the chart and this side of the chart. Let me just erase some things here so that you can see what it looks like. This side of the chart looks like this. It's black. Nothing there. There's nothing there. You can't see anything. But that's what you have to play, into the darkness. So all you can do is say, I think this and I think that. You use your education. You use different indicators. You've informed yourself over time. You have some experience, and this is what you do. And if you're really, really good, you can be about 70% right. Nobody in the history of this game has a 100% record. Nobody. Well, here's GM. And this was not pretty. This was the beginning of the year. Hit a high of 67, over 67, 52-week high, and then proceeded basically just to take a dump for 9 weeks straight, all the way down into the 39s. I held my position all the way down. I rolled down my calls. I did what I could. I tried to salvage as much of the position as I can. And in the 39s, it was really starting to get tiring. And I can remember being at the office saying, look, I don't need it to go back up. I just need it to stop dropping. Every single day, it just keeps dropping. This was painful over here. Down $1 something, down $2, down another $2, 3 days in a row. It's like, where are we going with this? When you start getting that frustrated, that's when and if you have enough experience and you're getting that frustrated, it usually means you're at the end of it all. That maybe this is over, maybe this is done, but I don't know. The consensus EPS for 2022 on GM is 701. That's come down. 701. I've got a question mark there because I don't even know if that's going to be right. We're going to look at something. They had an 8K that came out Friday after the close. And I have a big question mark on it because I don't know how the market's going to interpret it. I really don't know how it's going to be interpreted. Their next labor contract ending is the end of 2023. So I don't have to worry about a strike over the next 12 months because they have a contract in place still there. So I don't have that headwind coming up. And we had a rebound here. We got all the way to 45, which is a strike price. And for the last hour of the day, it had a big fight around 45. It would get a little above 45, a little below, a little above, a little below. And I had options that I closed out, the 45 to 50 spread, which gave me some income. And yeah, with 10 seconds to spare, I got hit. And I had that bid out all day long. And only with 10 seconds left did I get hit. So this tells me that dealers were closing their books all the way into the end of the day. That's why we had a big fight around 45. So I don't know what to read into that because it was an options expiration day. And it was look, this company has options that expire every week. You don't have fights every week. But the off-week ones aren't as liquid and don't have as high a volume as the ordinary options. So it's the actual expiration day of ordinary options that matter. With consensus EPS of 701, I've got 4 different fundamental levels: 6 times, 7 times, 8 times, and 9 times earnings. 6 times earnings gets us to about $42. Well, you can call that $7, right? 6 times 7 is 42. This is 49, 56, and 63. And at this point, I don't know. I'm 50-50. It could go from 45 to 50 and it wouldn't surprise me. It could go from 45 to 40 and it wouldn't surprise me. There is some momentum here, which could probably fall over into next week, depending on how the market moves. If tonight on Globex the market is strong and that holds into the morning, and futures are going to open strong, I can see GM opening higher. If futures are weak, unfortunately, GM is a victim of the market. It will sell off with the market selling off. 701, I don't know if that's the right number though. I think that's a little aggressive given where commodity prices are and given where oil prices are. There is a long-term trend of rising oil prices and falling car sales. That if you look at the trend, if you put oil prices on a chart with U.S. auto sales, you'll see a drop in sales when oil prices rise. And being that oil prices are where they are right now, is demand going to be where we think it is? The only thing I think that's saving the car companies from this higher oil price right now is lack of supply. Because of all the supply bottlenecks in terms of the commodities that they need, in terms of palladium, in terms of the chips and chipsets that they need, you have lower production than you normally would, which means there are no sale prices. There are no discounts on vehicles. You're getting full price. So margins are really nice, but volumes are lower than they would be. So they basically can sell everything that they make. So, even though you have rising oil prices, I don't know so much that it can affect volumes at this low level. But on this one here, you can see implied volatility under 40% versus just like a week and a half ago, we were at 56%. There's a nice place to sell puts. Here's, it's not that great. It's still good. I mean, if you draw a line across here, as best I can, you can see that it's still higher than a lot of other periods in time where I was using the options here, so I shouldn't be that bad. But you kind of remember the good old days 7 days ago when you were getting big fat premiums, right? Let's look at GM's most recent 8K. And on this one, I just don't know how the market's going to interpret this one. Okay, here's the most recent 8K. This was made available Friday after the close. There are a couple of things we have to note here. The first one, additional investment in Cruise. General Motors has bought out SoftBank. They've entered into a share purchase agreement to buy out their share, and they're going to pay $2.1 billion for SoftBank shares. And SoftBank was going to make an additional investment, and since they're taking SoftBank out, they will make the additional investment of $1.35 billion in place of SoftBank. So that is a cash outflow of $3.45 billion that is going to occur. I'm not sure how the market is going to take that. We know that acquirers tend to overpay for things, and GM has been very vocal in placing a valuation on Cruise of $50 billion. They've mentioned it at several of their investor conferences over the last 6 months, which means they would have had to buy SoftBank out at the valuation they said it was, right? And then they're going to have to make that investment. Is the market going to see that as, well, that's a cash drag on the company. There's cash flow out that you're not going to have anymore. And, is it really worth $50 billion? We don't know. Or will they say, for GM to make that kind of commitment, it really must be worth $50 billion? And if the total market cap of the company is, 70 to 75 billion and Cruise alone is 50 billion, shouldn't GM have a market cap of over 100 billion at this point? I don't know. They already had Cruise. All they're doing is buying out another owner, another equity owner out of Cruise. It's not as if they're buying something they never had. They already had this. It was already there. I don't know if the market's going to focus on the cash outflow or on the greater ownership. Anyways, it's not without costs. This is the recurring liquidity opportunity program. And this had to do with the stock options. The stock options were tied to liquidity events that at some point new investors would have come in, there would have been a liquidity event, shares would have been sold, and that would have set the value of the options, and the option holders could have cashed out at that point. Well, there's going to be no liquidity event now. So you have to change the condition under which those options vest. If there's going to be no liquidity event, you have to change it. And if the market is not going to absorb the compensation expense, because that's typically what happens, you issue options, and options increase in value, but it's the market that absorbs that expense. It's not the company. Well, now the company is going to have to absorb the expense because they're agreeing to buy it back. So if we go to this last line here, right here. As a result of the modification of the equity awards, Cruise will recognize approximately $1 billion of compensation expense during the 3 months ended March 31st, 2022, for those awards that were immediately vested. So if you take away the liquidity event, suddenly a whole bunch of options vested and now are available. Well, there's no market to take it. There is no new equity investor that's going to finance it. It's GM that's got to do it. So you got $1 billion of extra compensation expense. But it's a line item on the income statement. It's a non-cash expense that has to be recognized because now they're vested. It's what historically would have been called an extraordinary item. So on an adjusted basis, I'm sure that when they report earnings, they're going to report it on earnings on an adjusted basis, and this won't be reflected, but it will actually be in there, but it won't be reflected, but it shouldn't affect cash flow either. But this will. This is going to affect the amount. It won't affect cash flow from operations because this is an investment activity, but it is still going to affect free cash flow. Cash still has to leave the balance sheet to make that happen, even though cash flow from operations won't be affected. I got a big question mark on this. This is not new. GM's investment in Cruise is not new. Taking out one other investor kind of seemed inevitable when they got rid of the previous CEO of Cruise because they weren't going to do an IPO, and that CEO said, well, I want an IPO. It has to happen. That's where my big payout is, and they got rid of him. It just seemed inevitable that they would have to take out the other investors if they were going to hold it that close. So is this going to be net positive, net negative? I just don't know. Anyways, be aware that that's what's going on, and then I do expect Monday or Tuesday, analysts who follow this stock are going to put out some sort of note about it, or they're going to update something about it, and I'll see what their interpretation of it is. Anyways, I've kept you for way too long here today. I've tried to cover as much as I can, I will see you next Sunday.